Allow me to introduce myself. My name is Rob Gill, founder, CEO of Epic Financial Strategies, and welcome to our masterclass, Life Insurance 101, where we're going to discuss how to access the living benefits and create generational wealth. You may have heard of infinite banking or how to become your own bank, or how the wealthiest families in history, like the Rockefellers, have used life insurance to create wealth that for them has lasted over 7 generations. We're going to dig deep and share these strategies with you today. Today, we're going to cover 3 specific things. Number 1, the EPIC way. And what is EPIC? EPIC stands for empower, protect, integrate, and coordinate. Very simply, the outcome is to create the optimal amount of wealth with little or no additional out-of-pocket cost through the integration and coordination of all of your assets, taking advantage of certain financial products while minimizing the disadvantages along the way. Number 2, how can we use life insurance way beyond the death benefit? Think of a Swiss financial army knife where you get multiple use of each and every strategy by having life insurance as the centerpiece. Last but certainly not least, we believe that your mind has to be right first in order for money to come into your, let's call it your economic system. If you don't deal with your wealth wounds, you may grab some money but give it away just as fast as you get it. So the mindset and the action steps to set this up are necessary for you and your family as you teach them the action steps as well. Whether you're an entrepreneur, an investor, corporate executive, W-2 employee, single parent that has a side hustle at night, knowing that there's more out there than traditional planning, this is for you. Your parents would have loved to have learned this 30 and 40 years ago to pass it on, and now you get that opportunity to pass this on to your kids. Wake up, folks. Traditional financial planning is a hoax teaching you how to become an employee, not how to become financially free. We're taught to give our money to traditional financial institutions on a regular and ongoing basis so they can hold it for as long as they can and then give us the least amount as possible based on taxes, inflation, and all other things that they'd like to throw in our direction. We're also taught to give our dollar just one use. For example, prepay your mortgage or dollar cost averaging, and there's many more. Why not be able to get your money to get multiple uses, not just a singular use? And that's what we're going to get into today. What if there was a system in place that gives you leverage, liquidity, and control and allows you to harness each and every dollar for maximum use? What if you could take that same dollar, invest it into alternative investments, while at the same time it's earning a guaranteed rate of return that compounds it uninterrupted and gives you protection from lawsuit, inflation, and interest rates? Today, the goal is to empower you immediately to stay above status quo, not only just living in your wealth while you're creating it, but pass it on successfully. Part 1. Mind your business. You are the most important person in your financial world. You produce. You play a key role in decision making, and only you can provide insight on what success looks like for you. You're the return on investment. In order to mind your business, even if you have a day job, and to get to the right professional on your team, you need clarity on what exactly you want. What is your outcome? What does financial freedom look and feel like to you? Understanding where you are now, very important. How can you maximize your cash flow? Equally as important. What does your personal balance sheet look like? Assets, liabilities. What buckets are they in? Are the funds accessible within 24 hours? Does your balance sheet reflect what you want to be? This is why we love life insurance so much, because if it's done the right way, it's like a Swiss Army knife of financial planning. This special kind of life insurance contracts, not just traditional whole life policy that's meant primarily to purchase the biggest death benefit in case you die. It's the kind of life insurance where it's a centerpiece of the overall financial mosaic that provides protection, leverage, and guarantees. This is overfunded whole life insurance. To do this the right way, there's 3 things you want to look at. Number 1, the right kind of company. What does that mean? A mutual life insurance company where policy owners, this case would be you, are owners and are entitled to interest and dividends. The insurance company will pay you on a yearly basis. Number 2, the right insurance contract. One that maximizes living benefits, minimizes the insurance benefit, allowing the accelerated cash value to accumulate. And number 3, the compounding mindset, aka long-term mindset. Understanding every dollar parked here will grow for you forever, and committing to a compounding strategy is key. This is not get rich quick. This is not overnight success. This is building wealth one brick at a time. Part 2, leverage, liquidity, and control. What is leverage? The ability to borrow funds to finance investments to amplify your returns. A strategic use of resources to gain a competitive advantage. Liquidity, easy access to cash. You'd like to be able to get that within 24 to 48 hours. Control, the ability to create the terms in which to handle your money. Now remember, you want to make sure that once you start leveraging this money, you're not exposing yourself to the things you can't control, like market risk, fees, inflation and lost opportunity cost. Keep in mind, you're not borrowing your money, you're collateralizing your cash to use it for other opportunities while still compounding those same dollars uninterrupted. Maximizing the living benefits of the right kind of insurance, and this is an important piece, it's about using the same dollar in two places at the same time with minimal risk. While you're building your cash, you could still invest, loan to others, or finance your own debt, creating the true life insurance bank. And the key here, folks, it's not and or, it's and. No longer do you have to choose. You could actually do both. Part 3, retirement or getting down the mountain safely. This is important, folks. A lot of people are worried about outliving their money in retirement. This asset, your life insurance bank, can not only add value during the working years while you're accumulating the wealth, leveraging and buying other investments, but it gives you the permission slip once you get to retirement, knowing there's a death benefit, to spend all your assets down while the death benefit eventually replaces it. Now, remember, the traditional rule says, hey, there's a 4% spend down. So in other words, if I got $1 million, I take 4% a year out, or $40,000 a year, versus if I have cash value life insurance with cash value inside the policy that I can leverage in retirement, instead of taking 4% of that million, I could do principal and interest, maybe 8 or 9%, maybe get $80,000 or $90,000, knowing whenever I shuffle off this mortal coil, in other words, pass away, the death benefit's going to replace it. But what if you're a worker? What if you're a teacher? What if you're a cop? What if you have a pension? And the day before you retire, they give you a choice, either single life distribution or joint and survivor. Single life is a pension maximization, which means you can get more money now on a monthly basis, and when you pass away, your death benefit will replace the difference. These are different strategies that you could use along the way, or just take all your cash value in retirement, put into a pension plan so you could have a guaranteed number every single month. The bottom line is this. This is a financial seatbelt allowing you to go safely down the mountain while at the same time staying ahead of taxes and inflation and lost opportunity cost. Part number 4, protection, disability protection. I want you to think of it this way. If you become disabled and can't pay for your policy anymore, whether it's physical or mental, the insurance company will cover the cost of those premiums on a yearly basis, which, by the way, not only guarantees an income stream, but it also gives you the ability to still use your money in a multiplier fashion. You also have creditor protection, a little bit different though. This is tied to the state that you're in. So in the fine print of the policy, no matter which one you get, you'll have to look deeper into that with your attorney. But there is a level of creditor protection inside these policies as well. Last but certainly not least, protecting your future human life value, your ability to produce and provide for your family for years to come. It's important to understand that, listen, if I'm 45 and I'm going to earn $5 million or $10 million over the next 20 or 30 years, it should reflect that in the death benefit. If I own a home and my home's worth $1 million, I don't want to have $700,000 worth of homeowners insurance. I want to have more than $1 million. So the same thing should apply to your life plus. Anyway, it's important to understand that these little goodies inside this policy gives you things that you don't think about until you have to think about it. Part 5, saving strategically and powerfully. This means adopting the profit-first mindset. See, the profit-first mindset method founded by Mike Michalowicz is a cash management tool for businesses that channels humans' behavior. Very important. It requires taking profit out of your cash deposits before paying expenses. But remember, you need to mind your business, and this is how you do it. It's about making yourself a priority, squandering less and saving more so that you could create the life you really want. And let me be clear, this is not about penny pinching. It's about cutting out the BS. You know exactly what I mean, so you can get out of the rat race. What if we could find money that is flying off your balance sheet and instead help you reallocate those dollars more effectively? What if you had a forced savings plan that guarantees a bright financial future? How powerful would that make you feel? Well, if there was a step 1 after earning money when it comes to wealth building, it's this: overfunded life insurance and becoming your own bank. This is the single smartest tool you could use no matter where you are in your journey, no matter how old you are or whether you're an entrepreneur or a W-2 employee. And because compounding interest is a function of time, interest rate, and amount, the best time to get started is now. There is no tomorrow. When you wake up, tomorrow becomes today. And remember that starting is choosing to adopt the compounding mindset, aka a long-term mindset. That is what's required if you're committed to building sustainable, generational wealth one brick at a time. What's next? Now, if you're still with us, not only am I thankful, but your future self is jumping up and down with excitement. If you could ask yourself, what could this look like for me? Well, let's get into it. Now, because we are talking about life insurance, everyone is going to go through a qualification process called underwriting, where the insurance company evaluates how healthy you are. They get one look at it and gives you what they call a guaranteed offer. Keep in mind, even though they give us an offer, there is no obligation to take the offer, so there's no pressure. It just allows us to present the strategy to you. The underwriting process consists of a health exam and an application, but do not worry, we've got your back. It's our job at Epic to make sure that you fill out the application the right way and that you're represented in the best possible light in order for us to lock down the best health rating, and that's what we're really good at. Once we have this offer, then comes down the customization process where we do a deep dive to understand which funding strategy is best fit for you right now and in the future. And by the way, this is based on a cash flow analysis, 4 to 5 different phone calls, so we put you in a right position to prosper. Is it going to be the slow build? Is it the dumping strategy or the convertible term strategy? See, what is important is not only to develop a sustainable plan that aligns with your current situation, but one that has flexibility and can evolve to cater to the financial abundance you are destined to achieve in the future. Okay, so check it out, folks. What I'm going to do is a scenario if somebody wants to do the become your own bank model, and what that would look like strategically versus a traditional policy, so you guys can see what the difference actually is. This is going to be based on a hypothetical approval, so it'll be different than when you run through your own underwriting because it's going to still be based on gender, age, and approval rating. But with that being said, let's look at what this says at the top, value client traditional presentation. And what this is, on the left side, you'll see outlay, what age, outlay, what the dividend is, what the net cash value is, what the net death benefit is. And on the right side of the page, if someone in this scenario is 36 years old and they funded it to 55, and then they waited to get to retirement, they would have an income stream in retirement that is tax-free up to basis. And once you get up to basis, you would borrow from the policy to maintain that tax-free status. So in the scenario here, we're looking at an outlay of basically $480,000 over 20 years, to get back approximately $844,000 in 20 years during retirement. So if you were to compare this to a traditional IRA and 401k, not just on the contribution side where, remember, you get the write-off on the IRA and 401k where this is with after-tax dollars, but the IRA and 401k on the distribution side, that's where they could run into a challenge competing with this because they have to maintain a rate of return while still taking distributions. But anyway, what I'm saying is you want to analyze this completely when you make your financial decisions, and you want to be able to understand, hey, is there a way that these could work together, meaning a traditional whole life policy on the distribution side that can give you balance and protection on the distribution side of an IRA or 401k, because as we all know, they get taxed at ordinary income, whereas everything off of this traditional policy will be tax-free up to basis once again, and to maintain that tax-free status, they will borrow from the policy thereafter. So, for example, if you're 70 years old and now all of a sudden tax law, for whatever reason, that specific year goes to the highest it's ever been, you may want to take less out of the 401k and more out of the whole life. Conversely, if taxes go to the lowest they've ever been during that age, you may want to take more out of the 401k and less out of the whole life. It gives you a chance to manage the tax code based on all the different products that you have. But anyway, if we look at this, $2,000 a month or $24,000 a year, in year one, you see $4,000 of net cash value, $4,382, which is basically what the dividend is. So whenever you go online and people talk about the cost of insurance and they really poo-poo the whole life strategy, these are the policies they're talking about. So in this scenario, if you really look at it, the break-even point is probably past the 10th, 11th year, to be exact, right? And that means when I say break-even, how much you put in versus what the net cash value is. If you do this for the long term, I have a lot of policies. My first 5 or 6 look a lot like this. If you do this for the long term and continue to fund it, and even if the stock market's going up or if it's going down, this gives you a level of protection. I'm not saying do one or the other. What I am saying is a perfect mosaic would be a combination of both. Once again, that's in general terms. This is not a recommendation. I'm just speaking in educational terms, and you want to be able to monitor and measure everything you say. So on this first policy, basically you have $24,000 in outlay, Cost of insurance is real in that first year. The distributions later on in life give you tax-free up to basis to maintain that tax-free status you would borrow from the policy while still having a death benefit. In effect, it allows you to spend the death benefit down during your retirement years. Let's go to number 2. So number 2, if I'm, and as I'm taking all you through this would be how we handle a client in our 90 to 120 day process. We have about 6 or 7 meetings. So we go through multiple cash flow analysis. We build out the financial website on the eMoney platform, which we call the Epic Wealth Builder. And we spend a lot of time in getting to know you, the client, not only your core values, but what your goals and objectives are. And then through that, we're able to figure out cash flow, money reallocation, and or strategically maneuvering your dollars. So in this hypothetical situation, once again, I have to say it again, just for educational purposes, we now have a client that, and you'll see it says value client presentation with a $150,000 dump in, but you could see year 1 is $200,000. So what does that mean? In that first year, the client had, let's say, $300,000, $400,000, $500,000 in a savings account, and we talked about, hey, if you dump that in there, in other words, if you did a lump sum dump in the first year, this is what it would look like. So you have $50,000 as your baseline premium. That could be paid annually or monthly. In this case, it would be like $4,200 a month, and then the person dumps in $150,000. Now, let's say in month 1 you pay your premium, and then all of a sudden 10 days later you want to do your dumping. You could wire that money in, and then if you want to have access to that money 10 days later or 15 days later, you would wire 90, close to, if not 90% of it out. So 90% of 150 is about 135,000 approximately. It could be a little bit more, a little bit less. So for example, if a client's on the verge of buying a rental piece of real estate and they know that the down payment's going to be $120,000, what they typically do is after they make their first payment, they wire in that dumping amount so they could pull it back out and use it as a down payment. You may say, Rob, why do they want to do this? Well, remember, in the policy, you get 2 rates of return, which is dividends and interest. In real estate, you get 4 rates of return, which is cash flow, mortgage interest write-off, depreciation, and appreciation. However, if you run your down payment through this policy and then leverage off the policy to put that into the real estate, and now you have the renter pay back the policy, you get a 7th rate of return. That's essentially become your own bank. Let's say if you want to finance your own debt, if you're going to, finance a car through your policy versus through Honda, through Ford, through Toyota, there's a way that by financing it through your policy, you make that interest back for yourself that would otherwise go to the bank that you have your car loan at. Same thing if you want to be a hard money lender. Same thing if you want to buy businesses. In the scenario that you're looking at now, this hypothetical client, we realize that this is the best version of themselves. However, if we did this version, it may stretch them to save every single dollar. So we're never going to recommend it. We want them to see what they're capable of under their current circumstance. And last but certainly not least, on that same hypothetical client, this is the one that we would feel sits and fits with their core value as well as their cash flow and is a comfortable strategy that ties into their overall goal. So here you have $2,000 a month savings, and then you have $100,000, what we call dump in, right? So this is where the overfunding comes into play. So it's significantly less than the best version of them, as you could see. And now it's $2,000 a month. And when we talk about dumping, folks, remember, even though it says $100,000 on this one and $150,000 on the one before it, they or you don't have to do that amount. You could do up to that amount, right? And there's a lot of these policies, you're able to overfund for more than 1 year. I don't want to show you 99 different illustrations in this conversation, so we just like to go with 3. And obviously, if you really want to learn this, you'll be able to meet with us one-on-one to really get a customized strategy that sits and fits with who you specifically are, because you might not be a male or female 36. You could be a male or female that's 56 or 26 or 66. So this is just hypothetical, as you could see. But with that being said, once again, $2,000 a month, which is the baseline premium, $100,000 dump in. You see the access to the net cash value. So in strategy 2 and 3, there's much more access to cash value than there is in strategy 1. Strategy 1 is a traditional whole life, where strategy 2 and 3 are really become your own bank strategies that we utilize for our clients. Anyway, the income on all these policies is the same, not the number, but the same in the sense that it's tax-free up to basis to maintain tax-free status you borrow. And the key here in strategy 2 and 3 is the net cash value, the money you have access to, is there much faster. And if you are a strategic entrepreneur that knows exactly what you want to do with your money, time, freedom, these are the strategies to go with. Once again, it has to sit and fit with your core value. It has to make sure that all of your financial educators are on the same page. A lot of times there's educators that don't want to talk to the other educators. The reason why we do the Epic Wealth Builder, aka the eMoney platform, is so we can hold everybody accountable, including us. Anyway, I hope this illustration created some clarity for you. There is flexibility within these, much deeper conversations one-on-one, but we wanted you to get a flavor of what this could look like. But remember, you could choose the slow build strategy and still accelerate cash values and take that step towards becoming your own bank. Those numbers were hypothetical, but they're relative to everybody. Although they're different, the impact is the same and it's powerful. For those of you who are really beginners, like all of us were at one point, there is still a way forward. See, as mentioned earlier, the underwriting process is the qualification process for life insurance where your health is evaluated. In order for you to lock in your current health rating, which is going to be phenomenal at a younger age, and not risk the chance of becoming uninsurable in the future, you could lock in your preferred rating. We could warehouse the difference and then put you through the insurance strategy of convertible term policy that allows you to go back in and convert that over time. A term life insurance policy that is cost effective but has the ability when you're ready to switch into a whole life policy that can be overfunded like I just showed you and become either the slow build strategy or the dumping strategy, it gives you that flexibility. If you have not done so already, please connect with one of the experts here at Epic so they could take you through our success process and help you take the next step towards elevating your financial future. I look forward to meeting you personally. Get on that strategy session now. No obligation, just education, and learn what your next best step is in your wealth creation building journey.